Prateek Agarwal is business head and CIO at Ask Investment Manager and now joins in. Thanks so much for being with us, Prateek. While experts are talking about tensions unlikely to snowball into any further confrontation, FPIs as well remain net buyers. What is your take on the markets in this, uncertain time?
Yeah, so I think it is now time to become more positive. Beginning of the year, we had a lot of issues to tackle. There was an ILFS issue which was India centric. We had our elections to take care of, which again is an India centric phenomenon. And in between, because of the currency and commodity turmoil that we all saw, oil moving up sharply and then correcting to a similar amount and more, and currencies also depreciating sharply. The third quarter numbers were expected to be not so good and volatile. Now that period is also behind us. So going forward, we are looking at better numbers on a sequential basis and YOY basis, and at the same time some bit of the concerns are getting addressed. If we look at the world around us, of the major emerging markets, we seem to be doing the worst, and I think that kind of factors in the issues that as a country we are facing. A lot of it is fear rather than actual impact on the ground, and as those concerns are taken care of over the next 2 to 3 months, in the post-election phase, one should expect to see some brush of green that is today sweeping the world to come and help our indices as well. That is our thought. If we look at the Brazilian market, they underwent their elections towards the end of last year, and since then that market is up handsomely over 1.5 months by over 15%. So that is something that the investors need to put at the back of the mind. Valuations which were higher a year before, since markets have gone nowhere and earnings have moved up 13-14%, that kind of valuation correction has definitely happened, and valuations are now just a tad over long period average on a 1 year forward basis. So I would say time to relook at the market. Yes, stagger, but definitely relook at the market at this juncture.
But Prateek, just in case, if things were to escalate from here between us and Pakistan, would you say that's spelling bad news for a direction of the market which is already just about, very range bound with a big overhang in the elections coming up too?
No, so don't do anything at one go. The whole idea is to stagger, but the point is also that once these concerns are taken care of, one should expect the market to be buoyant. And if today the valuations are just about average and maybe a tad higher than average, as these concerns get taken care of, you should expect to see a bump up, which would then make the valuations on the stiffer side. So from environment related concerns that you have today, the concerns then would be more valuation related. Now we have a lot of issues, I am not denying that. Yes, things can escalate. Our hope is that they don't, but they can. But that said, it would be nice if we go back and see what happened in 2008 Lehman. That event in terms of financial markets was very bad, but valuations cracked and came back to the pre-Lehman period in a matter of 6 months. So valuations are what determines the level of the stock market. Unless you are saying that we enter into a full-scale kind of an event with the neighbor, the chances of which I will put as very, very low. I would ask people to be more focused on valuation rather than the noise that is being made across.
Okay, so Prateek, how best should one, really make use of this uncertain time? What would you say is looking attractive for a buy, or at least where can we start at least nibbling in? I want you to talk about the mid and small caps, not particularly the large caps here.
Yeah. So mid and small caps, we would believe the stress should continue for a longer period of time. A large part of the mid and small cap, whichever way you can classify them, are actually suppliers to the commodity end user. So a steel plant may buy consumables, they may buy graphite rods, they may buy, even plant and equipment. But the end buyer is a commodity player, and same with oil refinery or oil producer like an ONGC. Now, many of these companies on a global basis have cut production because global growth has slowed down and commodity prices tanked, and hence their suppliers are no longer having the same kind of pricing power as they had earlier last year when the global growth was extremely strong and people were asking for delivery yesterday rather than tomorrow. So that's a change, and I guess some bit of it would manifest itself in earnings numbers going forward. The second thing to remember is that mid caps have seasons. So, for example, 91, 94 was a season for cement, 97, 2000 for IT, 2004, 2007 for infrastructure, real estate kind of space, 2000, the recent one, more on China related stuff. So, chemicals, commodities, kind of stuff. Now, typically we don't see the same space getting replicated over the next period, and there is a distance between the two periods. So yes, 1 year the mid cap part of the market has not done well. Maybe this year they do similar to the larger cap names on an index basis, but the leaders could be very different versus what we saw in the last period. To my mind, actual leadership will emerge, over a period of time. I will give it a year before that happens.
Okay. So let's talk about some opportunity then. You're talking about the consumption trend, two-wheelers. You spoke about the chemical sector as well. What about these microfinance companies? At a time like this, when the overall environment is shaky, experts are also, alluding to more liquidity pain within the space. What makes you bullish here?
So we did not speak on these subjects, but let me touch on that. We are very positive on the microfinance space. As long as the company is rated well, AA minus or better. The recent RBI policy, makes flow of money to the space higher or at a cheaper price or both. And this is a space which has tremendous amount of pricing power, and they are able to re-lend with a 10% margin for sure, as is the RBI norm. Banks can actually charge higher. So very good space. How much is the total credit flow to the space is just about 1.75 lakh crores. The demand for credit could be in excess of 6.5. I mean, these are numbers which we have kind of got from the industry itself, and hence, since the demand supply gap is so large, practically every company in this space is growing in excess of 30% on a compounded basis. More good things have happened for the space, versus earlier when there would be loan waivers, for example, and that reduced the borrower discipline and impacted NPAs for the space. What has been done this time around is to put 6,000 rupees a year into the pockets of the poor, which is the class to which microfinance companies lend to. A 6,000 rupee a year Government of India annuity money may be worth like 50,000 rupees upfront, and that is the kind of amounts a microfinance company usually lends to its customers. So there would be a whole lot of leverage between overlap between who the beneficiaries of from the government are and who the microfinance financiers target. Given the fact that now the borrowers have a very visible flow of money, we believe that this space will see lower NPAs if at all going forward.
All right, that's the take on microfinance. Prateek, thanks much for joining in and giving us your take on the markets as well as sectors that you're bullish on.